Hey, Steve, and thank you for joining us. We are looking at the next view of our Fraud for Thought webinar series. Delighted to say that we've got Steve Lenderman on the call, who's a new joiner to Quantexa as the head of fraud in North America. Hey, Steve, don't mind if you just give a bit of background to yourself and your experience.
Absolutely. Well, welcome. Thanks for having me, Alex. As Alex mentioned, I'm a new joiner with Quantexa, just about 90 days into the role. Prior to Quantexa, spent time in fintech industries across the banking sector, worked for global payroll providers, and also in the financial sector with credit cards and peer-to-peer payments. So, been doing this for about 25 years, and now I've made the jump over to Quantexa and looking forward to working with these guys in North America.
Fantastic. Yeah, great to have you on board, Steve. And I know a lot of your experience comes from obviously the insurance sector, but also across some of the other financial services sectors and payment sectors. And I think that's going to be really relevant in today's session, where we're talking around synthetic and emerging threats within identity fraud, synthetic fraud, account takeover, and similar vulnerabilities that occur both within the FS world, but also now emerging within the insurance world. So I guess with that, we'll just sort of start with a bit of the current trends, really. What are you seeing at the moment with regards to recent and emerging trends used by criminals, cyber criminals, with regards to identity theft and synthetic fraud?
Yeah, so it's been quite interesting to see the shift take place from the financial sector to the insurance space. Fraudsters will always go where the money is, and the money they now realize is very prevalent in the insurance space. And the insurance space, while very mature from an organizational perspective, has always dealt with fraud, but not the type of fraud that the financial sector has seen. And so now we're seeing these threat actors coming into the insurance space with things such as synthetic identity, deep fakes, generative AI that is out there. So it really comes around technology, is that the insurance marketplace is being targeted by threat actors using technology that the insurance space just hasn't really quite seen yet. The banking sector has been seeing it for the last 5 or 6 years. And now the insurance space is now seeing it, and it's only the kind of what I call the fraud tsunami, where they're just seeing the kind of things, the waves come in, and that's the fraudsters kind of playing with things, understanding the insurance. First of all, understanding insurance, where the really money is, what the controls are, what the program is, and then they'll launch their attacks with technology. So we're seeing a lot of things like bot attacks now. That are being used and scripted to apply for policies, for example. Whether they are successful or not, it doesn't really matter to them. It's really a testing strategy for them to understand, again, what the controls are that the insurance has in place, seeing what they get through. And if they get a policy applied, they may not do anything with them for a while. They may just sit on them and kind of, again, understand how the program works, where the control gaps are, what the thresholds are, and kind of how those accounts we call sleeper accounts just kind of sit there and sleep for the activity. On the synthetic side, right? So you're seeing traditional identity theft, and you're seeing synthetic identities that are now being and have been used and groomed and matured in the financial sector are now moving into the insurance space. So I was speaking with a rather large insurance provider and discussing some synthetic identity identifiers. And they quickly ran their identifier and found a $5 million life insurance policy they paid out to an individual that does not exist. And they started looking more and more into it and found roughly $40 million in death benefits they paid out to individuals who never lived. And so that is a huge red flag for the insurance industry, that this threat is coming to them, is at their space, and will start to expand and land as they move forward.
Yeah, and the sad reality I think we've seen is that this is only increasing now within the insurance sector. And I'd be really interested in your perspective on the scale and frequency that these attacks occur, and the sad reality that it doesn't only impact insurers, but it also impacts the average citizen. Can you tell us a bit more about that?
Yeah, absolutely. So I'm never really a huge fan for statistics because, especially in the fraud world, obtaining loss data is very, very difficult. So much of it is unreported from a consumer perspective, and honestly, a lot is unreported, from the organization perspective, right? And so it's the iceberg theory, right? We have these numbers that are floated around. Some of these numbers I've seen range from 50 billion in losses to trillions in dollars in losses, and somewhere in the middle is, I would assume, the truth, like always. The The number that I've seen pop around most is around 80 billion in losses. Globally, I think it's probably much higher than that. Obviously, it's always underreported. What I found interesting, was just doing some initial research, was there's a rough estimate between 3 and 4% of all claims in the insurance space are tied to fraud in some way, shape, or form. So if you look at the scale of the number of claims globally, and 3 to 4% of those are potentially fraud, that is a significant number that I think, again, the insurance organizations are just not really prepared to deal with those influx of claims, right? The financial institutions have had large teams of investigators and analysts and hundreds of people working these things. The insurance industry, has always had fraud, but not this type of fraud. What is also kind of interesting is that less than 2% of these claims that are deemed as fraud are actually prosecuted. And so we have this theory with the bad guys aren't being prosecuted, that it's very profitable for them, which means there's no deterrence, and they will continue to go after the insurance market over and over again, mostly because it's relatively easy for them. And secondly, the last stat I'll throw at you is that, again, they're saying about the average loss is about $1 million or so in an insurance fraud claim, which that seemed really high to me. But even if it's half of that, if your average take on one fraud claim is 500,000, that's a significant amount of money for a fraudster to take. And obviously, the risk and reward, and they'll go for it. So I think it's going to be really interesting. All those numbers point to a growing fraud trend, and also point to growing losses, right? Because we all know fraud's going to continue to happen, losses will continue to increase, and those losses have to be absorbed by somebody, which most of the time will be on the consumer, right? And we saw that in the 90s and 2000s with credit card fraud. The banks continued just to raise interest rates until the governments regulated those rates and fees, but the consumer always ends up eating the losses in fraud. So that's bad news. And rates, I can tell you right now, my rate climbed just last month. So, and I'm a good driver.
Yeah, no, it absolutely impacts, everyone day to day from an insurance perspective. And I think, it's interesting to me how the insurance market is now evolving to be, more competitive in the way they differentiate their own products and services. So looking at more self-serve products, looking at more digitization and straight through process, and looking at new and emerging products through personalization. I'm interested from your perspective in how those sort of positive changes in the industry are maybe also opening the gate for additional types of fraud to occur.
Yeah, absolutely. The pandemic has altered and modified lots of things we do. For example, most of us in the past probably had bankers or brokers that we dealt with, right? When it came to your insurance policies or when you went to the bank. Those days are over. Now everything is self-service, online. Consumers really do not want to interact with individuals. They want to interact with platforms and programs and apps. And so the self-service digital model is the way of the future. And you're going to start seeing some new players that are already kind of peeping their heads in the competitive market in the insurance space from what we call the fintech side of things, right? Where now the big players in the insurance space are going to see this creep in their scope from these fintechs, which again will force the big competitors to get much more competitive with the digital aspect of things. So understanding how the fintechs onboard, kind of a slightly different conversation there. But what we're really going to see here is, the lack of the human interaction now, which for many fraud, and what I would say enterprise fraud program management, there's always a human somewhere in the chain, and that human is now being removed from the space, and so you're going to see this. You're going to see more risk out there, essentially allowing individuals to process through an entire application with almost zero interaction from humans, if any at all, in typically a minute or less, and have an instant gratification of a policy being approved, insurance issued correctly, and it's active all within 2 or 3 minutes, which used to take 2 or 3 weeks in the past.
Yeah, for sure. And I'd like to sort of take a move now. We've talked around some of the trends we're seeing into why the insurance market is struggling to deal with these types of frauds right now. What do you see as being the primary challenges holding insurers insurance companies back, and what are they faced with now in terms of new vulnerabilities, new processes that they need to put in place in order to get greater control over this?
Yeah, so I briefly mentioned earlier that the organizations of insurance were typically a very always paper heavy, human organized, in the office type event, God forbid I say faxing documents back and forth, things. And so the industry itself has been accelerated to a digitalization, as we mentioned, right? Self-service. And that program is relatively, immature at this point. The banks have been kind of already doing that for a little bit of a while, so they were a little more adapt to the change with COVID. And so you're seeing the insurance companies just kind of, okay, getting up to speed finally with what this really looks like and how it works. They're also, again, I mentioned they've seen traditional insurance fraud for decades, right? Which have been just, fake claims, it's individuals. And now you're seeing transnational organized fraud rings attacking the insurance companies at scale. And that's something they just have not seen in the past. And it will not go away until they can mitigate the controls and put things in place to stop them, and basically shift them to another industry. But for now, the fraudsters definitely have the insurance market in their sights as a prime opportunity for revenue, and are going to go after them until the insurance companies basically put enough walls up to stop them and deter them. It's going to be really interesting how this plays out in the next 3 to 5 years, is my guess. And hopefully the insurance companies will take lessons learned from the banking sectors on what to do and what not to do. And for example, one thing I'd put out there is the banking industries rely very heavily on step-up authentication via a cell phone, right, or a mobile phone, where there's a text message to authenticate that you, and that is fantastic if it's still 2005, but we're clearly past that time. And so I would highly recommend the insurance companies not follow in that footstep of using a mobile number for authentication, because it's antiquated, and the fraudsters have already figured that out. And if you try to put a control in play that's already a decade behind, you're not solving your problem, for the now or for the future.
Yeah, and you touched on a couple of aspects there, which was leading into my next question, which is fantastic, around being able to elaborate on some of the difficulties that insurers have when they're trying to distinguish real from fake, especially legitimate policyholders versus potential, identity thefts or identity policyholders, and especially in the sort of remote and online interaction space where you're not going to a broker, where you don't have that agent involved. Can you just elaborate a little bit more on some of those difficulties and why they exist?
Yeah, listen, every organization, whether it's an insurance company, a retailer, a bank, right, it's all about customers. We have to have customers, and that's what makes our business go around. So the ultimate goal there is not to eliminate true customers, right? You do not want to identify a true customer with a false positive and deem them as potentially fraud. And then you alienate that customer, and they go to another competitor who may or may not obviously onboard them as a customer. So you've lost revenue from that perspective. The other is, if you do onboard that customer, what was the experience like? Are they willing to stay? Is the pricing competitive? Because again, pricing is driven by operating expenses, which tie back to fraud. And we know in the insurance space, particularly in the United States, it's a very transient, right? They hop from insurance agency to agency, relatively quickly changing agencies. And so, you may get the customer, which is a moral victory, but how long can you retain that customer if they have a negative experience in your platform? The last thing the insurance organizations have to really understand is how much friction to apply on a new customer. We all want self-service. We want it done quickly. We're typically doing these things on our phones or on trains or in between meetings, for example. And so you have to provide them with a good experience, and that experience needs to be relatively frictionless, so the good consumer will move through. Here's something that I want everybody to think about: that a bad experience will be tolerated by a fraudster, right? But a good customer will not tolerate a bad experience. They will abandon and they will quickly leave your platform to find another competitor that Google will spit up to them. And so when you're looking at your onboarding, I highly recommend that you look at time on page to really understand what your consumer looks like. How long does it take them to complete an application? If your average time is like 2 minutes, for example, and you have individuals taking 25 or 30 minutes, that's an anomaly. It's called a red flag, probably fraud. If you also have an application that's being processed in 3 and 4 seconds, that's a bot. That's also fraud. And so you have to understand what your customer journey looks like and to be able to, so that you can mimic that to your best customer experience, but also eliminate the bad threat actors from coming in your front door.
Yeah, and you talked around the impact there on the honest consumer and the good customer and the risk of, not treating that process correctly and therefore losing customers. For me, there's also a risk potentially reputationally here for insurers, getting a grip of this fraud threat, because the impact of individuals who've had their identity stolen, who've had their policy account take over, who've had fake implications of things like life and medical policies is a real reputational risk, I think, for insurance companies. So where do you think that stands in today's market? And do you think, regulators and compliance may come in place to help protect the consumer from this?
Absolutely. So from a consumer perspective, let's think about our own lives, right? When we have a negative experience, we like to tell people about that negative experience. We rarely want to communicate great experiences to individuals. So the stat I heard was that if you have a negative experience, you typically will tell 3 individuals about your negative experience, and that can expand. 3 becomes 6, 6 becomes 12, and so on and so on. So the agencies really do not want that from a marketing perspective. So they want to keep that individual happy as possible. But if you look at the much bigger picture reputationally, I would say if there has been a fraud issue or some kind of regulatory issue within a large organization reputationally, that ends up kind of being more of a short-term thing, right? It looks bad for a few weeks. Eventually, consumers and the population as a whole kind of tends to forget about things. You look at some of the large breaches out there. For example, the Sony breach, right, was a massive breach. Did it affect Sony? No, we all have Sony televisions and PlayStations. We're still doing things of that nature, right? So the reputation from that perspective, I think, at the high level, is a short-term problem. But what it does do is initiate mid to long-term problems, as you mentioned, from regulatory perspective. Now the regulators are going to want to look and see, what's under the covers, what's under the hood. They'll start asking more questions, and then when regulators come in, they will obviously try to look and help you fix your problems, which essentially means more headcount, more controls, more policies, more procedures, and all that really cost more money, right? And so the response to a regulatory finding is typically an expensive one. It does have some reputational damage to it through some fines and a press release. But the most important part that you want to avoid is that the increase in cost, because your margins are shrinking, in particular on these policies. So you definitely do not want to have the regulators under your covers. But I also will see, just like the banking sector, is that they're out there to protect the consumer, and so enough consumers start to become victims of fraud, you will see the magnifying glass focused on insurance policies about what they're doing to protect their consumer, and are they doing enough?
Yeah, and I definitely expect to see some movements over the next 3 to 5 years in the regulatory space there, for sure. So one definitely for insurers to watch out for. So we've talked a bit around the trends of what we're seeing and some of the challenges, and now let's get to some of the opportunities, I guess, for insurance companies in how they can start to combat these types of threats. So from what you've seen, how are insurance companies adapting their tactics to help defeat the fraudster, and what strategies and technologies are they putting in place to enhance that capability?
Yeah. So as you mentioned, technology, right? To combat technology, you need technology. The old days of the human firewalls, like massive fraud shops of hundreds of analysts working in reports and queues that really produced a lot of false positives, just can't sustain that scalability, especially with the level of fraud that is, in my opinion, coming into the insurance space, right? It will be that equivalent to the financial sector we saw in the last 2 decades. So you have to have the appropriate technology in there. It's pretty easy. The insurance companies just need to look to the banking sector again. What do they do? It's really about account onboarding, right? You want to keep the bad guys out of your account at all costs, because once they're in the account, then it's very difficult to mitigate them, and it's expensive to mitigate them out of your portfolio. So you're looking at things at the onboarding stage is what I call a proactive stage versus reactive. The reactive stage would be they're in your books, they do something, may make a claim, but that has already started the process, right? So now you're kind of always behind trying to fix that. What you want to get into is the proactive stance where you eliminate the fraud threat altogether, which means you don't you don't approve the application for the policy. You deny them at the door. But how do you do that? Like, how do you prove fraud intent? This may look like fraud, but until they do something, is it really fraud, right? Just because I'm carrying a firearm doesn't mean I'm going to go out and commit a homicide. But when I do, then it becomes a homicide, right? And so it's very difficult for banks and technology to determine what we call the intent. So they're looking at things and tying the data together, right? They're looking at things such as device information, behavioral biometrics are out there. We're looking at non-traditional data sets instead of traditional data sets like credit bureaus or large data aggregators. You're looking for things that would help you tie things together, which ironically ties to the concept of entity resolution. Excuse me. And so, how do you tie all that technology together? How do you tie all the data that you obtain through those technology into a workable, queue for your analyst? Because the false positive rate can be somewhere in the 95th percentile. So you really got to understand what your data you're trying to acquire, what you're going to do with it, and then how to use that data in the truth data format to retrain your models and tighten your defenses.
Yeah, really good insight there, Steve. Thank you. And I guess just to build on that, how are some of those technologies helping insurers strike that balance between the customer convenience and the stringent validation that insurers should put in place when it comes to identity verification? And you mentioned deep fake authentication. So how are those technologies really helping strike that balance?
Yeah, it's most important to understand the connections within the data, right? Back to entity resolution there, understanding that these are not individuals sitting in a basement with the hoodie picture, right? These are transnational groups that are attacking at scale. So when you attack at scale, there's relationships and connections between those online applications or between those accounts. The trick is to understand what those relationships look like. And so, you're looking at again, mentioned device identification, for example. Individuals will try to spoof their computers, right? You can no longer trust IP as a valid data detection. It just doesn't work because IPs are too easy to spoof or proxy VPNs, for example. So we have to look at different things as like deep device identification, understanding where they're coming from. I mentioned deep fakes and synthetics. Synthetics have been groomed in the financial sector for the last 20 years, which are truly just data points, right? I had an identifying name, identifying number, addresses, etc. Now what we've seen is deepfakes are creating now both visual and audio for the actual synthetic identity. So now the synthetic identity has a face and has a voice. And so you've seen a lot of the technology come around about liveliness checks, send us a picture of a selfie, turn your head, go on WebEx, go on Teams, whatever it might be, to prove that you really are a true human. The technology has progressed so quickly in the last 2 years that's easily defeating most technology that the banks and insurance companies have in place to defend. So then we go back to the concept of a human trying to do things. So it gets really interesting to see how this space is going to change in the next 2 to 3 years. But I would highly recommend that they look into what the banking industry has done, and most importantly, I think is sharing the information between themselves. Banks have been doing that for a while now through organized groups. The insurance companies do have some organizations within their scope of business, and the analysts and investigators do talk to each other. But I believe it's very much in an informal structure. There needs to be some kind of formalized structure to take all this data, put it all together, and say, listen, we know this is a bad actor because they attacked insurance company A and inform insurance company B, right? The banks have made that mutual connection and relationship to say, listen, we're going to fight fall together versus looking at it as a competitive disadvantage. Like sending a bad guy from us to them is better for them. Like that doesn't happen in the banking world these days. So they work together from a consortium perspective to identify those data sets.
Yeah, and one of the things which actually came up as a topic in the recent Global Insurance Fraud Summit was the nature of transnational fraud threats and cross-regional fraud threats. And I think that's becoming more prevalent now that you haven't got these barriers because the digital channels exist to be able to target from an organized criminal perspective. So you mentioned data sharing there. You mentioned the ability to provide industry intelligence. Sort of what have you seen as best practices in that space that insurance can learn from?
Yeah, the first thing they do is learn to talk to each other. Again, looking at it from a collaborative perspective versus competitive. A lot of early fraud defense platforms really were what I would say defend and deflect, whereas as long as they don't come to us, we don't care where they go. And it was almost like, it's better than them than us environment. And then need to, again, switch to a collaborative environment where if we're identifying a particular bad device or application, whatever it might be, that data is shared. Now it can be salted and hashed, anonymized, so that you're not sharing PII, which is obviously very important from privacy standards and legal perspectives. But they have to work together in this situation. I think they also need to talk to the banking sector to understand what they saw 3 years ago, because that's what's coming into the insurance space now. It's the best predictor of the future is kind of the past, and you're going to see that coming forward as we move on. And as the insurance companies make this shift to a technology, to a fintech more stance where everything is on apps and you're submitting claims online, with your phones, taking pictures, all that opens up to the ability to manipulate data, manipulate pictures, to misrepresent yourselves, for example. And the pay of insurance claims, can happen now in seconds, right? Through an app, right, or through a program. Where in the past it would take weeks to get an insurance payment because they would send a check, and you would get it in the mail, and it would take forever. And if you committed a fraud, and they could probably cancel the check. But when you're making an instant payout, you have minutes to make decisions, and that is something that they need to really think about, because real-time payments are going to affect, and faster payments are going to affect not just the banking industry, but the insurance companies as well.
Yeah, thank you for that insight, Steve. And I guess at the top of the call, you mentioned some things around the role that generative AI and machine learning is playing, and how the fraudsters are actually using those capabilities to start to target the insurance companies. I guess it would be remiss of me to not talk around how those techniques can also be used by insurance companies to combat the fraudsters. So what role really does machine learning and artificial intelligence play in improving the insurer's ability to detect those suspicious activities?
Yeah, we couldn't talk about fraud these days without talking about ChatGPT or any other generative AIs that are out there. And it's very interesting to the fraudsters because they can use the models that are not regulated, right? So if I were to ask ChatGPT to create a fake insurance fraud claim, or it wouldn't do it, right? But the fraudster version of their ChatGPT, which is again free for them to use, not regulated, and as effective, if not more effective, because they're not regulated. And so you're going to see this exact use to create documents, to create claims, to create scripts. And as insurance companies get into the world like banking and fintechs have gotten into, right, where you're now using chatbots to accept claims and to reduce call center volume. And now these generative AI and ChatGPT are basically having chatbot wars. They're breaking down the chat to the chatbot on the insurance side to determine where can I get in, what's the weaknesses, what's the controls. So you're seeing that perspective. You're also going to see, when calls are inbound these days, they're typically going to a third-party call center, and that third-party call center is all about average handle time. And you're going to see, again, a deep fake generative AI individual, a person behind the screen. So it may be my face, but I can import a whole other individual, male, female, different race, different gender, doesn't make a difference, to match the identity that's on there. Even using your picture or my picture and steal my identity and then put my picture on the generative AI that's out there. Or like I mentioned earlier, even scarier is creating a brand new face with generative AI and a brand new voice that has not been seen or heard to match the new identity that I've created and I'm using in this space. So it's going to be really interesting to see how this plays out, because again, we have to play by rules. They don't, and they're using technology That is not regulated, and they're much more likely to share and open source that data to each other, that technology to each other. And the banks just can't do that. It takes us how long, and the insurance companies, how long to deploy a solution? Months, sometimes years. Not the bad guys. They're doing that in days, if not hours. So it's a constant race for us to keep up in that perspective.
Yeah, and like you said, constant arms race at the moment, and definitely insurance companies need to be putting a lot of effort now, I think, to tackle these emerging threats and the emerging threats that are coming from other industries. You mentioned a lot around financial services, but we certainly see fraudsters that have targeted retail companies, public companies, government entities, then starting to target insurance companies because there's a path of least resistance there in the controls. So a lot for insurance companies to think about. With the last sort of minute or two that we've got left, Steve, would you just like to sort of wrap up with any closing remarks and maybe any comments on how the insurance companies can now take the steps forwards proactively?
Yeah, it's not all doom and gloom, and as fraud fighters, we're constantly, in a pessimistic environment. So it's not all doom and gloom. Obviously, I think they can, as I mentioned, use lessons learned from the banking sector. The playbook is there, obviously to modify it slightly for insurance, but the reality is insurance companies are moving money just like banks move money, and so if you use that playbook that's there, I think you guys will be in a great position to defend yourself. There is going to be a little bit of a storm and a little bit of a learning curve for the organizations right now because the fraud is already in your platforms, it's in your programs. You have to weed it out and move forward. The one thing I'd also recommend is if you don't think you have synthetic identity fraud in your portfolio, the answer is you do. And you should start looking through your bad claims, looking through your defaulted accounts, et cetera. In the financial sector, in the default space, it's between 10 and 15% of the defaults are some way, shape, or form tied to fraud, typically synthetic identity or identity theft. So if you don't think you have a fraud problem, you do. Just have to go look for it. And we don't want to do that, but we have to do that to understand what the problem is. And last thing I'd probably add here is what the banking industries have done is that they're starting to use what we call truth data or the good data that's out there, right? We know what a good customer looks like because we have more of them than we do bad guys. And so all too often we try to use modeling and AI and machine learning to, identify the bad guys. Well, let's identify the good guys. There's more data. It's better data. And we can model to that versus, identifying the bad guys. So that's something the banking industry has figured out about 3 or 4 years ago, and it seems to be working for them. So I'd recommend the insurance companies also look at what the good consumer looks like and use that to identify the bad.
Well, thank you very much for that insight, Steve. I really, really appreciate your time on this call. I hope for those that have watched, you found it interesting. Please do get in contact if you'd like to learn any more. But for now, I would just like to close that off and say thank you very much.
Pleasure having us. Thank you.
Thanks, Steve.